Hi everyone, welcome back to 8th video of redemption of debentures. Now in this video we're going to see this another method of redemption that is called conversion into shares. Here basically what will be happening is the debentures will be converted into shares. That's all it is, yeah. But you have to understand all the technicalities of that and everything and how we have to solve the problem, yeah. So that's what we are going to do in this video. But before going into this video, please make sure you have watched the previous 7 videos of this chapter. Yeah, now some of the videos are silver club only videos and some are free. Fine, so you have to see that in the playlist. And we have covered until now 2 methods of redemption. The first one was the lump sum method, and then we have also seen the installment method in the previous video, just the previous video. Yeah, so that's what we have done until now. Now let's get back to this video and let's understand this method, yeah, conversion into shares. Now let's understand the concept of this method. See, here it's very simple. It means redeeming the debentures by converting them into shares. The debentures will be converted into shares, and those shares can be preference shares as well as equity shares. It could be both. Okay, now you have to understand which type of debentures can be converted into shares. Now you all know on the basis of convertibility, the debentures are of 2 types: convertible debentures and non-convertible debentures. Now here in this method we are talking about conversion, and you all know non-convertible means it will not be converted. So this category is completely out of the picture. Non-convertible debentures, NCDs, we also call that as NCDs, yeah. And then here you have convertible debentures. Now convertible debentures are also of 2 types: FCDs, fully convertible debentures, and you also have PCDs, partly convertible debentures, yeah. See this chart, see here, it's very simple. Debentures on the basis of convertibility, you can categorize that into 3: FCDs, fully convertible debentures; PCDs, partly convertible debentures; and NCDs, non-convertible debentures. Now here in this method we are completely ignoring this, yeah, because here we are talking about conversion and here the conversion doesn't happen. Leave this, yeah, it's completely out of the picture. Come to these two, FCDs and PCDs. Now FCDs means what? The name says itself, fully convertible debentures. So everything will be converted into shares. Yeah, that's simple. Then here you have PCDs, and 99% of our problems will be based around this. Yeah, PCDs, partly convertible debentures. Now here in PCDs what happens? Here you will have 2 portions. As the name says itself, partly convertible. Yeah, partly convertible means what? Some of that will be converted into equity shares and some of that will be paid in cash. So some of that will be convertible portion and some of that will be non-convertible portion. See here, 2 portion will be there, convertible portion and non-convertible portion, yeah. So convertible portion mean it will be converted into shares, and non-convertible portion means it will be paid in cash. Yeah, did you understand that? So the question will tell you 1000 debentures are there. Now these debentures are 40% convertible and 60% non-convertible. Is that okay? And then you also have to understand, see here, the option of converting debentures into equity shares lies with the debenture holder. Now this convertible portion is there, yes, that's fine, but now the company cannot take the decision whether they will convert or not. No, the debenture holders will take the decision, yeah. They will have to exercise the option. See here, understand this properly, it's very simple. The debenture holders, this person will have a right, not an obligation. He will have a right to choose whether he wants the shares or not, yeah. So if he exercises the option, he will have an option, yeah, a right. So if he exercises the option, if he goes for the option, then only he will get the shares for his debentures, yeah, for the convertible portion, yeah. If he doesn't exercises the option, if he says I don't want shares, entirely I want money, then he will get entirely, yeah, his debentures will be redeemed in cash. Is that okay? So if he exercises the option, what will happen? For the convertible portion he will get shares, and for the non-convertible portion he will get cash. And if he doesn't exercise the option, he will be paid entirely in cash for his redemption value. Is that okay? Right. So you understood this properly. The option of converting debentures into equity shares lies with whom? Not the company, the debenture holder. He has to choose, okay, whether he wants to exercise the option or not. Are you clear with this? It's simple, yeah. So that's what. Now you have to think logically, and I have said you in previous, in the conceptual video that, see here, let me just show you that. See here, in this DRR slide I have told you, see here, in case of partly convertible debentures, DRR shall be created in respect of non-convertible portion only. Yeah, so here just for an example, 1000 debentures are there. Let's say 40% is convertible and 60% is non-convertible. Then what you have to do, you have to create DRR and DRI only for the non-convertible portion. Yeah, so that's what you have to do. Yeah, that's what this red ink, this says. In case of partly convertible debentures, DRR shall be created in respect of non-convertible portion only. Is that okay? Right. Then see here, for this non-convertible portion, you have to create the DRR as well as DRI. Yeah, because here the cash is involved. Here there is a problem of cash, liquidity and all that. Yeah, so that's why DRR and DRI should be created. Yeah, it must be. Fine. But here for the convertible portion, yeah, here no DRR, no DRI. Okay, because here cash is not involved. Here definitely it has to be paid in cash. So that's why DRR and DRI, that compliance, 10% DRR and 15% DRI is a must. But here it's not like that. Here no DRR and no DRI. So now when you will pass the entry, how you are going to do the calculation of this and all. See, it's very simple. Let me just show you. See the accounting treatment. Yeah, see here, when you will create the DRR and DRI, yeah, only for non-convertible portion, how you're going to do that? See, it's very simple. How do you create the DRR? Face value of debentures, let's say 10 lakh is the face value of debenture. So 10 lakh rupees into 10%, that's the percentage of DRR, the adequacy, into percentage of non-convertible portion. Yeah, only that portion you have to take, the percentage of that. Just for an example, let's say 60% is non-convertible. The question will tell you, don't worry, you don't have to calculate on anything. No, the question will tell you 1000 debentures are there. Just for an example, 40% is convertible portion, 60% is non-convertible. So when you will calculate the DRR, simply you have to take 60%. Yeah, 10 lakh into 10% into 60%. Yeah, that's what you have to do. And when you will create the DRI also, 10 lakh into 15% into 60%. Is that okay? Right. So that's what you have to do in this DRR and DRI. You're clear with that? Yeah. And you also understood the logic behind this. The option lies with the debenture holder. He has a right to choose whether he wants the shares or not. Okay, fine. So you're clear with that. Yeah. Now the journal entries are all same. See here, all journal entries are same as earlier methods, what we have seen in our sequence and all. Yeah, all the entries will be same. Yeah, issue of debentures, of course that will be same. Yeah, because here redemption is not happening. And then create DRR only for non-convertible portion. The same entry you have to pass. Yeah, same entry, but for the calculation what you will do, you will take the percentage of non-convertible. Same here also in DRI also, percentage of non-convertible you are also going to take 10% into 60%, 10% into 60%, like that. Yeah, if non-convertible is 30%, so in 10% into 30%, 15% into 30%, like that. Yeah, you understood that. Then receive interest, pay interest, all that is same. Due entry is also same. Yeah, percentage debentures account. Yeah, if the redemption is happening at premium, then what you will do, premium on redemption account to debenture holder. Yeah, the due entry, everything will be same. Yeah, you will sell the DRI. Yeah, everything will be same. Make payment to debenture holder. Now when you will make the payment to debenture holder, of course now in this method payment is not happening. What is happening here? The conversion is happening, isn't it? Here in this method we are talking about conversion into shares. Yeah, so mostly, as I said, 99% of the questions of these conversion method you will get what? PCDs, partly convertible debentures. Yeah, you will get PCDs. So of course there will be a convertible portion and non-convertible portion. So in the question, some of that will be converted into shares and some of that will be paid in cash. So you will have to make a bigger entry. Okay, is that okay? So you will have to pay the money also. Some of the portion will be paid in cash and some of the debentures will be converted into shares. So you can also pass club entry or two entries separately. It doesn't matter. Fine. So see the entries of the conversion, yeah, only that you have to understand, because rest all the entries are same except for the conversion. So as you all know, the redemption can happen at par as well as at premium. Yeah, so if it is happening at par, then what you will do, see here what is happening, the conversion is happening. The first what will happen, first due will happen, पहले due होगा फिर payment होता है, isn't it? First it will be due and then it is paid, but here conversion is happening, so due first then conversion. Yeah, that's how it happens. So first you have to make due. So you will make the due as usual. Debenture holder liability will be created. Yeah, you all know that, isn't it? Liability cancelled and loss recorded. If there is a premium, that loss you have to record. And then here personal liability is recorded of debenture holder. Yeah, and then what do? The payment. Yeah, when you pay in cash, you cancel that personal liability debenture holder, isn't it? Yeah, that's what you do. But then here what is happening, here conversion is happening. So here you are giving shares to these people, yeah, you're giving share capital. So that's why what you're going to do is, first, as usual, let's say it is happening at par. If it is happening at par, then debenture holders liability will be cancelled off, that personal liability, yeah, which you made on the due entry, you will cancel that off, and then to share capital, yeah, capital is increasing, yeah, because you have created new capital, so capital is increasing. That's why what you have to do, you have to credit the capital account, share capital. It could be preference share capital or it could be equity share capital, yeah, fine. So that's a simple par entry. And then if the conversion is happening at premium, yeah, more than the face value, then what you have to do, debenture holders account debit, same, cancel the personal liability which you created at the due entry, and then create the share capital. New share are being issued, are being given to those debenture holder, yeah, so to share capital account, face value, and then whatever extra is there, let's say the market value is 20 rupees or something, and 10 rupees is the face value, and at that price you have issued the shares here, yeah, the redemption is happening at that price. Then what you will do, share capital only rupees 10, and the remaining rupees 10 or rupees 15 or whatever it is there, rupees 2, rupees 3, whatever is there, that will go to securities premium account. Yeah, you all know this is a basic entry, debenture holders account debit to share capital to securities premium. Yeah, so these are the entries that you have to understand, only the conversion entries. But now the main important thing is you will arrive at a redemption value. Yeah, they will tell you at what price the redemption is happening and everything. So you will have a value 1,50,000. Yeah, so 1,50,000 has to be paid to debenture holder. But now this 1,50,000, this money, you have to convert that. You have to convert that into number of shares. You have to convert that into number of shares. So how you're going to do that? To calculate number of shares to be issued, what you have to do, you have to make use of this formula. See here, the formula is very simple. Number of shares to be issued, yeah, how many shares you have to issue, equal to redemption value. What is the redemption value? You have to take that. In the question it will be given, they will tell you these much debentures are there, it will be repaid at this much amount. You don't have to take the face value, okay, you are taking the redemption value over here. The total redemption value you are taking, total redemption value, yeah, 1,50,000, 2 lakh, yeah, 15 lakh, whatever it is there, that entire value you are taking. In that redemption value, there is face value of debentures as well as whatever extra that you are paying to debenture holders. Both the things are there. Face value of debentures as well as that extra. Mostly there will be, okay, some premium or whatever it is there. That extra will be there. So both the things you are taking over here in redemption value. So of course, in the denominator, you can't take the face value. Don't make this mistake. Most of the people do this mistake, yeah. What they do is they take the redemption value over here and they become over smart and they take face value over here. Don't take the face value. You have to take the IP, issue price of the share, and if you divide that, and once you do that, you will get the number of shares. Take the number of shares into face value, that will go to share capital, into that extra money, that will go to securities premium. Yeah, first don't write the entry, first do this, first calculate the number of shares to be issued. Once you have got the number of shares, so number of shares into face value of the share, that will go to share capital, into that extra money, that will go to securities premium. Did you understand? Simple. So this is what you have to do. That's all it is. Yeah, it's very simple. Okay, do you understand this? Simple. Yeah, so that's it. Yeah, see here, you understood? Now let's do one practical question so that you will understand how to do this calculation and the mechanics of this problem in the calculation part I'm talking about. Okay, so let's solve one practical problem of the ICAI study material. Now here we have the practical question number 1 of the ICAI study material, but of our series this is problem 5. Is that okay? Right, so let's start. Let's understand and solve this question. So see here, a company had issued 20,000 13% debentures of rupees 100 each on 1st April 2021. So here we are talking about how many debentures? 20,000 debentures, and the face value of each debenture is rupees 100. Is that okay? Right, then they are saying the debentures are due for redemption on 1st July 2022. Okay, the terms of the issue of debentures provided that they were redeemable at a premium of 5%. So it means we are repaying the debenture holders 5% extra. Yeah, so see this carefully. The debentures face value is rupees 100. Yeah, each debenture face value is rupees 100. We are repaying them 5% extra. So we are repaying how much? 105, isn't it? See here, 100 is the face value. We are repaying 5% extra. So I will inflate this by 5% into 1.05. That's equal to 105. So 105 is the redemption value per debenture. Redemption value per debenture. Yeah, fine, you understand that. Then they are saying, see here, and also conferred an option to the debenture holders to convert 20% of their holding into equity shares, and the face value of those shares would be rupees 10, at a price of rupees 15 per share. The issue price of the equity share would be how much? It would be 15 rupees. The face value is rupees 10, and we are not concerned about the face value over here in the calculation. We will consider the issue price. I have told you, yeah. So that's what, at a price of rupees 15 per share. So this rupees 15 is our issue price. Okay. Then they're saying, see here, debenture holders holding, see, 2500 debentures did not exercise the option. I have told you the option to convert the shares or not will be with whom? It will be with the debenture holder. They will have to exercise. Yeah, they will have to exercise the option. If they exercise the option, then they will get the shares for their debentures, or if they do not exercise, then they will get entirely cash. You all know that, right? So debenture holders holding 2500 debentures did not exercise the option. Okay, so that's what. And then see here, calculate the number of equity shares to be allotted to the debenture holders exercising the option to the maximum. Now here they haven't asked you any general entries. No, here they are just asking you the number of equity shares that will be allotted to the debenture holders to the maximum. Yeah, that's what you have to calculate. So see, it's very simple. Let me show you. It's very simple. The first thing that you have to do is, see here, what is happening? 2500 debentures did not exercise. Yeah, debenture holders, people who hold 2500 debentures did not exercise the option. So first you have to calculate, number of debentures to be converted. Yeah, that's what you have to calculate. How many debentures should be converted? That's the first thing you have to do. Okay, so see, it's very simple. What you have to do is, see this, total number of debentures. You all know total number of debentures is 20,000. Yeah, so 20,000 debentures are there. Yes. Then what you will subtract? You will subtract the debenture holders not opted for conversion. So how many debentures? 2500 debentures. Yeah, isn't it? In the question it is said, see here, 2500 debentures did not exercise the option. So that directly you have to exclude that, because it will not be converted because they didn't exercise the option. Yeah, they didn't exercise the option. That's why you have to deduct that. So the debentures, the debenture holders who opted for conversion holding 17,500, yeah, only this much debentures were opted for conversion. Yeah, 17,500. See here, understand this properly. It's very simple. 20,000 total debentures were there. Yeah, 2,500 refused. Yeah, they did not exercise the option. So the left were, the remaining were 17,500 who exercised the option. But think carefully. Will the entire 17,500 will be converted into equity shares? No, of course not. It is a portion. We are talking about PCDs over here, partly convertible debentures. Some of that will be non-convertible portion and some of that will be convertible portion. And here in the question, they are saying 20% is the convertible portion. See here, convert 20% of their holding. Understand this logically. Yeah, 20%, 80% is non-convertible. So of this 17,500, only 20% will be converted into 0.20. Yeah, that's 20%. So that's equal to how much? 3,500. So only 3,500 debentures can be converted into what? Into equity shares. Yeah, now you will think that why didn't we take 20% of 20,000? We can't, because 2,500 refused. That's why we deducted that. And we took 20% of only 17,500. You understand that? Simple. So these are the debentures. Yeah, 3,500 the debentures that will be converted into equity shares. 20% of 17,500. You understand that? It's a very simple thing. Then what you have to do, once you have the number of debentures to be converted, what you do is you calculate the redemption value of that. Do you remember the formula? What used to be our formula? Number of shares to be allotted or issued is equal to redemption value divided by issue price of share. So first what you have to do, you have to calculate redemption value, but issue price will be given. It's given 15 rupees, right? So let's do that. See here, redemption value at 5% premium. You all know that. And here in conversion, we are doing conversion over here. So only 3,500 debentures will be converted. So you have to take this quantity of debenture, this number of debenture, 3,500 debentures into what? What did I tell you? Redemption value per debenture 105, isn't it? 100 was the face value. 5% extra we are paying premium. So into what? 1.05. I'm inflating the 100 rupees by 5%. That's why I'm multiplying it by 1.05. So that's equal to 105. So 105 is the redemption value per debenture. So 105 into 3,500. Yeah, redemption value per debenture into the number of debentures, that is equal to 3,67,500. 3,67,500. So this is what? This is your redemption value. This much has to be paid to 3,500 debentures. Is that clear to you? Right. And then issue price of share is directly given to you in the question, isn't it? See here, issue price of share 15 rupees per share, so that's what you have to take. Yeah, why do we take issue price, not the face value? Why didn't we take this rupees 10 nominal value? Because in redemption value we have both the things, the face value of debentures as well as the premium that we are paying, that 5% extra. That's why you have to take the issue price of the share. Okay, fine. And then what you have to do is, see here, apply the formula. Simple. See here, number of shares to be allotted, redemption value divided by issue price of share. So redemption value was 3,67,500 divide by 15 issue price of share. Let's do that. Divide by rupees 15, that's equal to 24,500. So 24,500 shares have to be allotted to the debenture holders, who have these 3,500 debentures. Is that okay? Yes. So that's all you have to do. Your problem is over. That's all they asked you to calculate over here. Yeah, so that's all you have to do. But we'll go one step further and understand. See this. Now these are the number of shares. Yeah, so if you multiply this number of shares with, you know, the face value of the share into rupees 10, that would go to share capital. How much would go to share capital? 24,500 into 10, that is equal to how much? 2,45,000. That would go to share capital account. And then that extra 5 rupees is there in the issue price. Now this is what? This is issue price of the share. This rupees 15. I'm breaking that down, yeah, into the face value and the securities premium, that extra rupees 5. Yeah, whatever that is over the face value. So that rupees 5 and this rupees 10 rupees will go to share capital, rupees 5 will go to securities premium. So 24,500 into 5, let's do that. 24,500 shares into 5, that's equal to 1,22,500. This would go to securities premium. See the entry? The entry would be like this. Yeah, previously what we used to do, when in the lump sum and in the installments, we used to pay the cash, debenture holders account debit to bank. Right now we are not doing that. We are not paying the money, we are giving shares. So cancel the personal liability of debenture holders, 3,67,500. Cancel that liability which you created at time of due. And now what you have to do, you have to give the shares. So to share capital, you're creating the capital is increasing, you have to credit the capital account, yeah, with the face value. Only face value will go to share capital, 2,45,000, only rupees 10, and whatever extra, whatever over the face value is there, that money has to go to securities premium. You all know this basic entry, isn't it? So this is all you have to do. Okay, first you have to calculate number of debentures to be converted. Now this is a very simple thing to do. Total number of debentures minus who have refused, then whatever you have, take the the percentage, the convertible portion, you will get the number of debentures to be converted. Then calculate the redemption value. Issue price will be given to you in the question. To calculate the redemption value, it's not a big deal. Take this and then multiply with the redemption value per debenture. If there was, let's say, the premium of 10%, then what you would have done, if there was 10% premium, you would have taken how much? 110. Yeah, so 3,500 into 110. Yeah, that's what you would have done, isn't it? Right. So that's all you have to do. Simple. Yeah. And then what will happen? This is just the conversion entry. Now if we are talking about the whole problem, then what we are going to do is, the remaining whatever debentures were there, they will be paid in cash. Yeah, of this 17,500, the remaining portion, 80%, yeah, 80% of 70,500 will be paid in cash, and these 2,500 will also be paid in cash, isn't it? I've told you there will be a convertible portion and there will be non-convertible portion. Non-convertible portion has to be paid in cash, and those who completely refuse, they will have to be entirely be paid in cash. Yeah, so that's all. Yeah, you understand this, right? Simple. Yeah. So now in the coming videos, what we're going to do is we are going to solve some more problems of conversion, full-fledged problems, and those videos will be only for Silver Club. Yep, that's it then. Bye.